Let me start this video with a surprising fact. If you put $100,000 in a regular bank savings account today, 10 years from now, the number on your screen might still say $100,000, maybe a little more with interest. But what that money can actually buy, that's a completely different story. Because of inflation, the purchasing power of that money could feel more like $60,000 or $70,000. The number didn't change much, but your buying power did. So the real question is, do you want your hard-earned money to slowly lose value, or do you want your money to work for you? Most of us grew up hearing the same advice. Put your money in the bank. That's the safest place. And yes, banks are safe, but safe doesn't always mean smart. There are three major problems with leaving too much money sitting in a savings account. First, inflation. Prices rise every year. Groceries cost more. Rent goes up. Gas prices fluctuate. Healthcare gets more expensive, but your savings account, it grows at maybe 3 to 4% per year, sometimes even less. If inflation averages 6 to 8%, you're quietly losing purchasing power every single year. Second, low interest rates. A typical high-yield savings account might pay 4% today, but that changes. And historically, savings rate often lag behind inflation. That means your money isn't really growing. It's barely keeping up, if at all. Third, easy access equals easy spending. When money sits in your bank account, it feels available, you see the balance, you feel comfortable, and you spend. Let me give you a simple example. In 2008, a guy named Mark saved $50,000 in his bank account. He planned to buy property someday. 15 years later, in 2023, that same property he looked at had doubled or even tripled in value. His $50,000 with interest might have grown to $65,000 or $70,000. But the house, it's now worth $180,000. He didn't lose money, but he lost opportunity. And opportunity cost is invisible, but powerful. Here's the truth. Money in a savings account sleeps. Money invested works 24/7. Warren Buffett once said that cash loses value every single day if it's not invested productively. So if not the bank, where should your money go? Let's talk about 5 smarter places. Number 1, invest in yourself. The highest return investment is often your own skills. Skills don't inflate away. If you learn coding, digital marketing, sales, AI tools, design, public speaking, your earning power increases. For example, an entry-level graphic designer might make $40,000 per year, but if they master UX design or brand strategy, that income can jump to $90,000 or more. That's not interest, that's leverage. When you invest in skills, you increase your lifetime income potential. No savings account can compete with that. Number 2, build digital assets. We live in a digital economy. YouTube channels, blogs, online courses, e-commerce brands, software tools, email lists. These are assets. If you invest $5,000, $10,000 into building a serious content platform or online brand, and you commit, it could become a scalable income stream. But that same $10,000 in a bank account might earn you $300, $400 per year. Which one has more upside? One is passive, the other is powerful. Number 3, smart investing. Stocks, ETFs, index funds. Savings accounts are stable, but the stock market has historically averaged around 8 to 10% annually over the long term. Index funds like the S&P 500 represent ownership in real businesses. When businesses grow, your money grows. Yes, there's volatility, but volatility is not the same as risk. If you think long-term, you can also diversify. Index funds, dividend stocks, bonds, REITs, gold, for example, has historically preserved value over long periods. In times of uncertainty, It acts as protection. Number 4. Small business or side hustle. Instead of letting $20,000 sit idle, you could start a local service business, an online store, a consulting practice, a landscaping company, a coffee stand, a digital agency. Small businesses can scale, savings accounts cannot. Even a modest side hustle generating $1,000 per month equals $12,000 per year. That's more than most savings accounts will ever give you. Number 5. Separate emergency fund from investment capital. Now here's something important. I am not saying you should keep zero money in the bank. You absolutely need an emergency fund, 3 to 6 months of living expenses. If you lose your job, if medical bills hit, if life happens, that money should stay liquid and safe. But everything above that should be allocated intentionally. Emergency fund equals protection. Investment capital equals growth. Most people mix the two. Smart people separate them. Let's zoom out for a second. Why do so many people keep all their money in the bank? Because it feels safe. But safety without growth is slow decline. Imagine this. If inflation averages 5% for the next decade, your money loses almost half its purchasing power in about 14 years. That's not dramatic, that's math. And here's something else to consider. Banks don't let your money sit idle. They lend it out, they invest it, and they earn from it. So the real question becomes, why should your money work harder for them than it works for you? Financial freedom isn't about saving endlessly. It's about owning productive assets. Assets that generate income, appreciate over time, and protect you from inflation. Most people don't realize this, but cash is simply a tool, not a strategy. Holding large amounts of cash long-term is like keeping your best employee asleep. When you invest wisely, you wake that employee up. You create options, you reduce financial stress, you gain more control over your future, and control is real wealth. It's not the size of your bank balance. It's the ability to choose how you spend your time, to walk away from bad opportunities, and to say no when something doesn't align with your goals. That's what smart investing creates. So let me ask you something. If you moved money out of your savings account today, where would you put it? Would you invest in your skills, build digital assets, buy index funds, start a small business, or invest in long-term real estate? Drop your answer in the comments, because how you answer reveals how you think about money, and how you think determines how you build your future. If this video helped you rethink your strategy, hit like, share it with someone who believes cash equals safety. And if you're serious about building wealth the smart way, subscribe, because here we focus on strategy, not hype. Stay smart, stay invested.